AGNC is the largest mortgage REIT or real estate investment trust that invests exclusively in agency mortgage-backed securities, or those securities that are issued by the three government-controlled housing agencies, Fannie Mae, Freddie Mac, and Ginnie Mae. In total capital, we manage more than $10 billion of shareholder capital and an $80 billion portfolio of agency mortgage-backed securities. So in its simplest form, you can think about AGNC as being a bond fund that invests exclusively in agency mortgage-backed securities that is structured as a mortgage REIT. Our goal is to generate attractive long-term returns, equity-like returns for our shareholders. Since our initial IPO in May of 2008, we've been able to generate a total stock return for our shareholders close to 500%. On an average annual basis, that translates to about 10.8% average annual return, which compares very favorably to the S&P 500 over that time period. Well, first off, AGNC was really born out of the great financial crisis when the housing market had all of the uncertainty and the agency mortgage-backed securities were essentially taken over by the government. At that time, it was a particularly great environment for agency mortgage-backed securities coming out of the great financial crisis. Agency mortgage-backed securities were extremely cheap, relative value basis coming out of the great financial crisis. The Fed was intervening in the market through quantitative easing, buying those underlying securities. They were easing short-term rates, very accommodative monetary policy, and long-term rates were coming down. That created a perfect environment to generate outstanding returns for our shareholders. And the mortgage REIT industry really grew from that point forward. Over those 4-year time period, the mortgage REIT industry grew by $50 or $60 billion of capital. So it was really coming out of the great financial crisis that created the perfect environment to grow our industry. The value, one of the key values, is being structured as a mortgage REIT. We don't pay tax on our earnings, but we have to pay out essentially all that we earn to our shareholders in the form of dividends. That is why we have a really high dividend structure. Most of the return to our shareholders comes in the form of a dividend. Today, our dividend yield is around 14%. Now, over our 17-year now peer life, we have paid shareholders more than $14 billion in dividends. Yeah, well, today's environment really is a good example of the bull case for mortgage REITs. In fact, our total stock return over the first 9 months of the year is in excess of 20%. And the bull case for mortgage REITs is the key risk that investors take when they invest in our portfolio. You are buying into a portfolio of fixed income securities. It's important for investors to understand that. And the key risk that they are taking is the market value of our portfolio will go up and down based to some extent on interest rates, and we provide that sensitivity. But the primary driver of value changes is the change in the spread between our assets, agency mortgage-backed securities, and our hedges or benchmark interest rates, which are swap and treasury rates. Just like a corporate bond, for example, if that spread widens, there's a value decline. And if that spread tightens, there's a value increase. The bull case for us is in the current environment that we're in right now, coming out of the tightening that the Fed engineered in 2022, mortgage spreads are extremely wide. In fact, they're double the spread, about 150 basis points to benchmark rates, about double the spread that existed from 2010 to 2020. So spreads are really wide. We're about to enter a period of greater Fed accommodation, which is going to steepen the yield curve as the Fed lowers short-term rates. And long-term rates are generally stable. Those three conditions, wide spreads, stable interest rates, and a steep yield curve, are the bull scenario that should lead to tighter mortgage spreads over time, which would drive our net asset value up and ultimately drive the value of our stock up. Well, the bear thesis is the opposite. When you invest, any investor, whether you buy into our agency, AGNC stock, that is buying into a levered portfolio of agency mortgage-backed security, or you buy a mortgage-backed security outright, you are essentially selling interest rate options to the homeowner, because that homeowner has the option to prepay that mortgage at any time at their discretion or extend it. So there's a lot of variability in the maturity profile of a mortgage-backed security. Interest rate volatility is negative for mortgage-backed securities, for our underlying asset class. So the bear case is when interest rates become very unstable, like they did, for example, in 2022, when the Fed was tightening monetary policy aggressively. Interest rates were rising very rapidly. Mortgage spreads were widening very significantly. And that is the scenario where our net asset value will decline. That was the driver of our negative results, just like all fixed income securities underperformed in 2022. That's the bear case. The pushback is that we've already gone through a lot of that repricing, a lot of that volatility. And now, as you look forward, the macroeconomic outlook actually is more stable. Interest rates seem to be stable today. The Fed's about to embark on an easing campaign, and mortgage spreads are starting to grind tighter, which is beneficial to our business, and is the underpinning of our positive outlook. Well, first, it's the dedication and focus of our management team. We have one goal and one goal only: to be the best stewards of our shareholder capital that we can possibly be. Everything we do is about transparency and taking actions to generate the best return for our shareholders. But importantly, this is a very significant fixed income asset class. It's $8 trillion of mortgage-backed securities out there, but they're very difficult for retail investors to gain access to. It's much easier for a retail investor to go out and buy a corporate bond than an agency mortgage-backed security. Most of it is institutional, and most of the investment is done through bond funds. When you buy AGNC's common stock, it's easy access to this really unique asset class that has a lot of diversification benefits. So you buy our common stock trades between 10 and 30 million shares a day, or 100 million to $300 million. It's an easy way for investors to gain access to this underlying asset class. Great diversification benefits, great dividend yield. Our dividend yield right now at 14%, as I mentioned, 12 cents a month, or $1.44 a share, has been constant for more than 5 years. Great return opportunities, great diversification benefits for an asset class that is very difficult for investors to gain access to. AGNC gives them the ability to gain access to this asset class through our common stock in a very liquid form.